Hi, this is John Kumarianos. Welcome to a new edition of Capital Considered. This is a special series within Capital Considered called Driving Returns. It basically means that I'm doing updates from the road because I'm busy on the road lately. So I want to call your attention to two articles I wrote recently that I think you'll find useful. One is a book review of Bill Bengen's new book. We've had Bengen on the podcast before. Bengen is, of course, a retired financial advisor responsible for what's called the 4% rule. He's updated the study that led to that rule, and he's up to the minimum that retirees can take from their accounts to 4.7%. Let me explain how this study works. Originally, 30 odd years ago, Bengen ran a simulation for someone retiring every single quarter, so 4 times a year, from 1926. And he saw how much a person could take the first year and then adjust it for inflation every year thereafter without running out of money for 30 years. And the worst year, which he called the safe max, or the mark that the amount that never failed, was 4.1%, and that happened to occur to the October 1968 retiree. You may scratch your head and say, why did it happen to someone in the 30s? That was a really bad stock market. Shouldn't someone have run out of money then? The answer is no, because inflation's really a killer, and we didn't have inflation in the 30s, we had deflation. Yes, we had bad financial markets, but they tend not to hurt you as much as inflation hurts you. And so if you retired in the 30s, yes, you had bad financial markets, but you had deflation and you were adjusting your payments out of your investment accounts downward every year. In 1968, you had a bear market coming pretty soon, but you also had inflation, so you were adjusting your payments upward every year, and that was the killer. That's what made only 4.1% the first year work for that hypothetical retiree. The results varied in that original study. Many people could take 6% or more. One retiree could take 16%, an astounding number, and not run out of money in 30 years. So, a lot of variability in that original study. And the same holds true for the updated study. Bengen did two main things for this updated study. He created a more diversified portfolio. Originally, he used only U.S. large cap stocks and intermediate term government bonds. This time he added small cap stocks, mid cap stocks, micro cap stocks, and international stocks to the mix. And adding small cap stocks alone allowed that 1968 retiree to withdraw 4.5% the first year and then adjust it for inflation without running out of money for 30 years. And then adding all the other asset classes allowed for a 4.7% withdrawal that first year. I should also add that Bengen added a cash component. So the portfolio he used was 55% stocks, 40% bonds, and 5% cash or treasury bills. And that's what allowed him to boost the 4% or 4.1% rule to 4.7%. The second thing Bengen did was, and his book provides a lot of tables and guidelines helping retirees who don't know how much, or their advisors who don't know how much they should take. He added a component where you judge the stock market on the Shiller PE. That's the current price relative to the past 10-year average earnings, inflation adjusted. And then a guess, let's say, for inflation, since no one knows how much inflation will be. But inflation's a real killer for portfolios, especially portfolios in distribution. And so the upshot is Bengen thinks a retiree can take kind of in the 5.5% range right now. Someone retiring this year can do that. Now, inflation's a real wild card. It's been very tame for a number of decades, really, up until 2022, when it peaked at 9.1% in the summer of that year. But it's come down considerably. It's not quite at the Fed's 2% target rate, and there have been a lot of political fights about it lately. President Trump is not happy with the Federal Reserve, what its interest rate policy is. He says there's no inflation, but inflation is not quite at the 2% Federal Reserve target. So it's a bit of a wild card, but in any case, Bengen thinks you could take 5.5% in that neighborhood, in the 5.5% range. Um, I recommend his book. I wrote a book review about it. That's why I'm discussing it now. I wrote the book review for Advisor Perspectives. You can all, advisors and non-advisors alike, can read it for free on that website. I think it's a very good book. It provides many useful guidelines. What you spend in retirement is still a very difficult problem because we don't know what market returns will be like, and we don't know what inflation will be like. But it's nice to know at least what the worst case scenario has been since 1926, or what what the worst what a retiree could take without running out of money in the worst case, which still stands as October 1968. So that's the Bill Bengen book review. The second article I wrote was just an update of how markets have done this year, and they've done extremely well, especially since April. Foreign stocks continue to outperform U.S. stocks. I wrote this article for CityWire, and you'll see that the MSCI ACWI, All Country World Index, ACWI, has outperformed the U.S. market, the S&P 500, this year, although the S&P 500 has come on strong since April. But foreign stocks still ahead. If you are an investor invested in foreign stocks, and you did not use a currency hedge, you're up 22.82% through August 27th. You're up 20% in emerging markets. You're up 17% in local currency in emerging markets. S&P 500, by contrast, is up 11.4%. If we break it down by country, here's a surprise. Southern European countries have done well. Spain's up the most at 53.92%. Italy up 43.33. So Southern European countries have done well. The worst countries are Japan at 16.76 on down to Denmark, a 15.92 loss. So if Japan's the fifth worst country and it's done 16.76, the global stock market has done quite well. If we break it down by country in emerging market countries, Greece is number one at 78%, staggeringly high return. Again, that's Southern Europe, and it turns out Southern European banks have done well. They are over their crisis that they endured about 15 years ago, and they have brought those Southern European countries up quite a bit. The worst emerging markets countries are Thailand, India, Indonesia, and Saudi Arabia. But again, the loss is pretty tame. So moving on, if we get a little more granular, we'll see European defense stocks have done extremely well. The European defense sector, that's up 73% this year through August 27th. So European countries, of course, getting their defense spending up as the United States pulls back from defending Ukraine and defending Europe in general. Take a look here at the Magnificent Seven. They're not all doing that well. The top three are NVIDIA, Meta, and Microsoft. They're up all more than 20%. But three of the Magnificent Seven are down. Tesla, Apple, well, two of them, Tesla and Apple. Amazon's only up a little bit less than 5%. Alphabet's up a little less than 10%. So maybe it's the Magnificent Three now instead of the Magnificent Seven. Another interesting chart by a fellow named Charlie Bilello, who posts many interesting things on Twitter. He shows that gold is about even with the Vanguard U.S. Total Market Index for the last 20 years. They have not performed the same way at every instance, but over 20 years, they have come out to about the same return. That's interesting. 658% cumulative return over 20 years. That was a surprising recent chart. Moving on to bonds, it's kind of a bifurcated market. The Bloomberg U.S. Aggregate, the main U.S. investment grade bond index, was up about 4.95% through August 27th. But the long-term Treasury index, the iShares 20-plus year U.S. Treasury index, only up 1.55. So shorter or intermediate term bonds do well. Longer term treasuries, not so well. So that's something to keep in mind because we're going to get a rate cut most likely in September. Fed Chair Powell has basically said he will do that, fulfilling Donald Trump's wishes. But the last time he cut rates, long-term yields went up. Remember, the federal funds rate controls short-term rates, but long-term rates have a mind of their own or are controlled by investors unless the Fed gets into that market again, which it did during the years after the financial crisis and then stepped back. So everyone's waiting for mortgage rates to go down if the Fed cuts, but they may not because mortgage rates are tied to the longer end of the yield curve or the longer end of the bond market. So we'll have to wait and see what happens. But that's about it for now. This is John Comarianos with a new edition of Capital Considered, or a sub-series of Capital Considered that we're calling Driving Returns. Signing off. Thank you for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.